Good morning, investors. Hopefully you guys are doing well out there. Time to talk about a Wells Fargo company, ticker symbol a WFC, reported earnings this morning, and spoiler alert, the stock market did not like it, rejecting the stock about 7%, which is pretty hefty for one of these bank stocks in one day. We'll talk about why the stock is selling off. We'll talk about if these give us reasons to maybe put this on a watch list or add to shares if you potentially already own some Wells Fargo stock. We'll take a look at just really quick, just a traditional valuation metric on this. Love to jump into these numbers. We'll take a look at the net interest income, the non-interest income. We'll take a look at charge-offs. This is something we talked about a few months ago. Earlier in the year, we talked about how the banks were increasing these charge-offs. We'll talk about if they're increasing or decreasing, what that means for Wells Fargo, what that means for the broader economy. And then finally, we'll jump over to the stock chart. This one is teetering on a level that I think could fill. I think you could pick up Wells Fargo shares at a reasonable price here. And when that is, I will tell you towards the end of the video. So Wells Fargo down to 7%. This stock pays a small yield compared to a lot of other companies out there, a lot of other bank stocks out there. So you kind of need price appreciation in this one. So this is why it's very important. I think if you're going to add to your Wells Fargo position or start one, that you want to be very careful about where you're buying this one, because I think you do need capital appreciation in this one. Now, Wells Fargo is in cost cutting mode. I don't typically like to buy companies, at least for the longer term, if they're in cost cutting mode. I want companies that are expanding, that are taking market share, things like that. But Wells Fargo is in cost-cutting mode. In fact, ISI analyst John Pancari expected that the company was going to cut about $10 billion of potential cost. Wells Fargo came in today and identified about $8 billion. So they're coming up short even what analysts kind of predicted. So they're going to they're going to consolidate branches. They're probably going to, lay off workers across their entire banking sector. So the commercial banking, real estate, all this stuff is probably going to consolidate under Wells Fargo. Maybe they're trimming fat. Maybe it's stuff that's kind of excess that they don't need. But sometimes this allows competitors to get stronger. We'll see what happens with Wells Fargo. Now, from a valuation perspective, you can take banks and look from price to tangible book value. Basically, if you liquidate the bank's assets, you get a tangible book value. And so the closer to zero, you're basically paying almost no premium for the bank's assets. Here, you're paying about 1 times for Wells Fargo. You see here, it's actually been quite a bit higher as of, last year. This thing was, 1.5, almost over 2 times tangible book value. It has run up recently. With the run up in share price, this probably doesn't reflect today's price. I think anytime you can get this at a 0.75 price to tangible book could give you and it doesn't necessarily signal a buy for Wells Fargo, but in my opinion could reinforce it if all the other things line up. The stock chart, the financials, and this price to tangible book could really reinforce and give you a really good entry point and we're probably still a little ways away from that. So let's jump over to the financials here. We've got the quarter ended here. Here's December right here, most recent quarter. We've got the previous quarter right here. So quarter over quarter right here. And then we've got year over year. So here's back in December of 2019 when just everything was smelling like roses back then. And so we got percentage change here. We've also got the year end. This was Q4 for a lot of companies and Wells Fargo included. So we'll see what's going on there. So we've got this net interest income. This is money that they make off interest. We see here it's declined quarter over quarter and declined year over year. We're down about 1% quarter over quarter, and we're down about 17% year over year. Obviously, with interest rates just being compressed, it's going to be tough for the banks to do that. Now, one thing that you can think of is eventually interest rates will go back up. When that happens, I guarantee you the Federal Reserve and the incoming administration here in the United States do not want interest rates to go up. They are going to be doing their darndest to keep them down, but on top of stimulus and things like that, it's actually, I think, going to be a little difficult to keep them low. We'll see what happens. That's probably more a macro theme there. Non-interest income, this is like fees and things like that they're able to charge. That is down quarter over quarter as well, basically flat year over year, but we were down about 9%. Maybe that has to do with maybe mortgages. I'm not exactly sure. They probably give you you a little bit of color on this inside the financials or the conference call. Total revenue came in at $17.9 billion. Okay, down about 5% quarter over quarter, about down 10% year over year. So declining revenues, they're cutting cost. Not always the best recipe, in my opinion, for a buy situation. But when we jump over the stock chart, we'll take a little bit more look at that. So net charge-offs here. So this is money that they had to charge off. People not paying their bills, paying their mortgage, paying their credit cards, things like that. I would guess these are probably a little bit underreported. How much? I don't know, because I know there's eviction moratoriums. There's the things you can do with your credit cards, things like that. That probably keeping this number artificially low. I don't think it's exponentially higher than this, but you want to just keep that in mind. We're down about 20%, which is good. When you have charge-offs, you don't want them as a bank. You're down 20% quarter over quarter, down 24% year over year, which is actually surprising. But again, I think some of this is influenced by the fact banks are working with customers, at least to a certain degree. Now, here's a big number: increase or decrease, when it's in parentheses, in allowance for credit losses. So banks set aside money for these net charge-offs, and whenever they increase it, they're anticipating that charge-off to go up. In Wells Fargo case, they actually decreased it. So it's showing you that they're not anticipating maybe as many. So that is actually good, in my opinion. Good for Wells Fargo, but good for the broader economy, that a bank like Wells Fargo is not anticipating as many charge-offs, at least in the shorter term, as they had previously done. So that is good. So moving through it, we've got our Wells Fargo net income came in about $3 billion. You might say, well, look, that's up quite a bit over the previous quarter. In fact, about 47%. It's about 4% over here. But again, the broader things that are happening here is our net interest and net income interest went down. Our total revenues actually went down. They were benefited by the fact that we were allowed to kind of take away some of this credit loss money. So that's just stuff you want to keep in mind. Also, our non-interest expenses is basically the expenses of the company. Those also went down because they are in cost-cutting mode. So that's also something that you want to keep in mind, that Wells Fargo was able to raise their earnings per share and raise their net income by declining revenues, decreasing their allowance for credit losses, and cutting costs. So not necessarily the greatest recipe, in my opinion, for a bank to really generate a lot of interest from shareholders. Now, we see loans here. Those are down a little bit. Deposits are basically flat. That's not that bad. And total assets are basically flat as well. Now, let's jump over the stock chart. We see here, Wells Fargo kind of made a top up here. It's kind of reversed here. We've got this large gap here, and we're sitting just above it. The gap actually starts at about 31.80. We're sitting about, a couple cents above that, a little more than a couple cents. We're sitting at about 32.50 right now at the current moment. So what I would not do is I would not necessarily jump in here at the current time. I think what's possible, one thing is possible, is Wells Fargo could consolidate above the 31.89, and that would give you a little bit more margin of safety in terms of stepping in here, maybe adding to a position. The other thing, which I personally would do if I had shares or I wanted shares, I would wait to see what happens to this gap, because if this stock breaks the 32.84, we see it, it was going there and then it hit a reversal really quick. So that just shows you how powerful these price points are. This 31, we'll call it 31.80-ish, that is a very key level. Any break below that, this thing keeps going down. This thing could easily come down here at about $30. That's $2, okay? On a $32 stock, $2 is actually quite a bit. It's almost 10%. So I would wait, see what happens. It could pull back. The first level where I'd want to think about maybe adding to a share position or starting a share position be right at $30.50, okay? But I wouldn't necessarily want to go all in here because we have all this price consolidation here. And in fact, if you zoom this out, there's actually pretty good, this is not a terrible level right here, okay? Could it go down even further? Absolutely. There's levels down here into the 20s. I think that would take a broader market sell-off or maybe a banking market sell-off to really push it down back into these levels, but more in the intermediate term, anywhere between 28, we'll call that 28.75 and 30.50 is where I would want to target this one. We've got all this price action in here. It is a nice area. You will have filled this gap or actually penetrated this gap. You would have come down here to this 50-day moving average. I think you'd give yourself a fair amount of a margin of safety there. Wouldn't necessarily want to go all in here because we've got other gaps to fill. The momentum will have completely broken down, and this thing could head down further. So I would gently tiptoe into this one because, again, you're not necessarily buying this one for the yield. Obviously, the lower it goes, the more this yield goes up, which stands at about 1% right now. They could potentially raise that. They could do some share buybacks, things like that. It looks like most banks are able to do that. I'm not sure if Wells Fargo is able to, but you want price appreciation in Wells Fargo. That's why I would really pay attention to your levels here. That's where I'd really be careful where you would buy Wells Fargo. So hopefully you guys enjoyed this one. We'll be back again soon with more videos all this week, next week, for the coming months, really all year. We've got an exciting year ahead in the stock market, and I'll be here to cover it or help cover it for you. Hopefully you guys enjoyed this one. We'll be back again soon. Good luck with your investments.